Hello and welcome to Movie Market Podcast. I'm J.R. Gondeck, and as always, joined by David Sokolovsky. David, first and foremost, most important, got a baby coming in a couple days. Wish you and Sophia the best, and have a few weeks off as another new dad.
Thank you, Jay.
So now, as
Yeah,
we look in, kind of recapping the month, which has been a big recovery overall. Let's kind of review where things are at and look ahead.
yeah, Jay. So I think you saw a lot of the momentum from the second half of April continue, and so the markets really continued to recover. The S&P was up about 6%, and really a lot of it was driven by the tech industry and the recovery there. You saw, better than expected earnings in a lot of cases, and the weakness of the dollar continues to contribute to some of that. Um, and then you saw the equal weighted index lagging a little bit behind the S&P. The one area that I think remains challenging is the small cap. As they're more impacted by interest rates and just fluctuations with activity, slowdowns potentially due to tariffs and concerns there. And the one area of opportunity that continues to be relatively strong is international. So you saw emerging markets up on the month and developed markets as well. Developed markets really kind of leading the way up 18% so far this year. Emerging markets up 10. So creating another area of opportunity for investment.
So as always, David, the question is, here's where we're at, where are we going? So I think it's a good time to maybe look back at, kind of the V-shaped chart you've talked about in the S&P, and then take a step back. There's been a lot of noise, obviously, in news over the last couple of months. But I think as you look at this chart, right, this is the S&P 500 over the last year, and you can see the dramatic decline from January, February levels into April, and then the dramatic rebound we've seen over the last 5 or 6 weeks. But when you take a little longer view, the markets have been relatively flat since October, overall. And if there was concern around the markets being overvalued or overpriced, especially as you come into the year, now we've had 2 or 3 quarters of earnings growth. And as you said, markets are plus or minus for the year as we kind of close the month of May. So looking ahead, to me, I hope we get back into the area of just what's going on in the economy, what's happening with the numbers. I mean, there's just been so many what could happen and what might happen with tariffs and inflation. And for the most part, that hasn't been too much impact, whether we hear earnings reports or you look at consumer spending or other things. I mean, the economy remains very resilient. Obviously, there was concern around the slow or negative GDP in the first quarter. But now as we're looking at the second quarter, you know, the Atlanta Fed has us well over 3% growth, right? And some of that could be trade issue driven, but despite kind of some of that noise, consumer confidence picked up dramatically this week. And as we look, there's historically a very high correlation between stock prices, gasoline prices, and confidence. And to me, as you take a step back from all the noise of what might happen and the concern ahead, take it a step back. The economy is in good shape. Inflation's okay, still uncomfortably high, from the Fed standpoint, but the concern around tariffs hasn't come to fruition. And the Trump administration continues to kind of push those off and negotiate. You've had noise around whether they're allowed or not this week as well. But companies have been planning for the plan B of what they might do, but for now, it hasn't been that much of an issue. And consumers are resilient, and that confidence to me is so important, David, as we look ahead, because with all the volatility in March or April, you're frozen. But now that things look like they're steady and that confidence is there, that could lead to a lot of growth ahead. And again, as we sit here today, the markets are basically break even for the year, and we've had those 2 or 3 years of really good earnings growth.
Yeah, Jared, I think one area that could really benefit from better consumer confidence is the housing sector, right? So we've seen a continued slowdown there. And we've seen, the overall housing activity remain fairly slow. But, hopefully as the consumer confidence picks up, we've seen the savings rate pick up as well. And as rates start to stabilize, potentially there's more activity, which, as we've seen, drives a lot of the earnings of companies that provide additional services, as we all know whenever you move, there's a lot more activity that goes into the economy. So that'll be one segment of the economy that could stand to benefit and is an area that we can continue to watch.
Well, and David, the interest rates are a key component of the economy, right? And again, I think as we look at the what might happen, that's been on a lot of people's mind. Everybody's been waiting for lower interest rates for the last few years, right? The Fed's going to cut, the Fed's going to cut. And maybe there's a few cuts on the horizon this year, but the reality is most people have adjusted. People are having more babies like yourself, and you want to trade and move. And there's been a lot of savings. And I've said the last few years, we've basically been in a housing depression as far as activity, right? And the reality is that low interest rates are not coming. And look back 20 plus years ago, 6.5% mortgages are pretty normal, and you had an orderly market. So I think you're starting to see that adjustment overall. But to us, I think as we look at where we're at, let's get back to the basics. What's happened with the economy? Where are things? There's going to be noise with, a tariff on Europe and then not a tariff on Europe, and there's going to be a lot of whipsaws within the noise of the market. But to me, as we look at the next few weeks ahead until we get to July and earnings, there's really too much to shake up the markets. We're going to have some inflation numbers. You're going to have some labor numbers next week. But overall, you continue to kind of be more in a positive trajectory overall as the markets break even. So I think that's kind of our base case as we're looking to where to go from here. And again, the bond market remains resilient, right? Interest rates were up a little, bonds were down a little bit in the month, but rates are relatively high. So there's still a comfort level of safety if you want to lean in that direction. But I think as you look ahead, if we're back to kind of the fundamentals of the economy, there's no reason stocks couldn't go a little bit higher as you look to the months ahead. Again, caveat with where the economy and where things go overall.
And selectively, Jared, I think it makes sense to take advantage of some of the higher rates. So especially as people approaching retirement are just kind of looking to lock in additional income, this could create some of that opportunity as well. So some of these higher rates provide, a significant additional benefit to savers and investors overall. So
Well, and on top of it, David, the market's, 5 months in, like I said, scratch positive now for the most part. If you were sitting in cash and you were earning that 4%, well, guess what? You, for the most part, have the same or higher return than the markets. You really haven't missed out. And looking ahead, so that could attract more cash into the markets, in the months ahead that I didn't miss out. There's opportunity. I see the growth. I see the GDP recovery, and you tune out maybe a lot of that noise and fear of what might happen and just wait and see. I mean, if inflation does get uncomfortably high and tariffs do have an impact, let's adjust. But for now, there really hasn't been a major, hit to the overall economy. And again, the momentum with confidence coming back looks fairly strong as we look ahead. So with that, David, I want to wish you all the luck, you and Sophia, and we'll touch base next month.
thank you.